live from the city. This is the High Valuation Code with Matteo Turi.
Hello, welcome to episode 11 of the High Valuation Code. Before we begin, it's the usual, or it's useful to understand the full structures of what are we building in this series. And if you remember correctly, we have 4 groups or categories, and the High Valuation Code is organized into these strategic frameworks or groups that take a business from early credibility through the final exit, whatever you want to do as an exit, like a public trade or sell, IPO, or selling privately. So if you remember correctly, group 1, we did fundability and value foundations. In group 3, we do leadership, governance, and trust. In group 3, we did scale, capital, and resilience. And today we are starting in group 4, which is exit, valuations, and deal capture. So over the past 9 weeks, we have been working inside group 1, 2, and 3. And today we start with group 4, as I mentioned, which is about answering the first questions investors always ask. And which is here, very early in the book already, Matteo, that's correct. And this is a link directly where actually in the introduction of the book already we are mentioning these things. Is what you have in mind is the exit. So in page 12 we already have this high valuation triangle here, and with this IP monetization, succession planning, and global positioning. So that matters because exit value is not built from one final negotiation. It's a build from the structure a buyer believes can survive without the founder. It's very important. We talk about founder detox already in early conversations. So today's episode is about that shift from building a business that performs to build it that one wants to transfer. And here's the thing. Most founders think exit is something that happens at the end. But you build a business, you grow the revenue, you make a profit, and then one day you sell it. But that's not how it works in reality, unfortunately. But there's a process, there's a system, there's a sequence. The exit is not where value is created, it's where the value is revealed, right? So it's a kind of a mind shift of how you position yourself. And in many cases, the valuation is reduced. Why? Because and the reduction, what I mean is when they get offer or the offers are below what you ask or you think is the expectation from your career or what you build at that point. Because by the time you reach that moment, I mean the exit, the structure is already set. So today we're going to challenge a very simple idea. I think you exit is already being decided. Right. So Matteo, welcome again. What and I guess the next question is, what do founders get through, or what the founders get wrong about exiting?
Thank you so much, Francisco, for the start. Well, yeah, exit is where, yeah, I say all the people think valuation is just a calculation.
Right.
It's something you engineer, you design. That's where really many people get it wrong, including finance professionals, I'd say sometimes. And what about founders? Founders, I think it's a negotiation.
Right.
When in actual fact, it's really not a negotiation. It's a test. A buyer is not just gonna ask you how hard you have worked, for example.
Right.
That's not really the point. Yeah, they're asking a completely different question. They're asking what survives without you. It's about value transferability.
Yeah.
And they ask really very specific question. One of them is can the business run without the founder? They will actually pay you for your absence, like your absence becomes really an important sort of value point, and then they will ask, can the revenue continue? Can decision be made independently? Can risk be understood?
Right.
Can cash flow be predicted? If the answer is unclear, the valuation will drop.
Right.
And sometimes, we're talking about potentially a business not really doing any exit at all.
Yeah.
In the worst case scenario, it's deemed to be worthless if most of the questions are negative. Um, Now, the real reason why this happens is not because the business is bad, but because it's not transferable. So this is the very
Right.
important question. It's not transferable, yeah.
Yeah, and this is something that actually comes as a surprise many times because they it's so dependent on the founder that actually when they say I want to sell or want to exit, the answer that I get is not what I expect. As you mentioned, the evaluation is not what expectation, or they say, well, unfortunately, we are not in a position to take this business. So the founder thinks they are selling a performance, but actually it's their own performance, but the buyer is buying something else. What is the buyer buying really?
Yeah, and this is why the financial statements are so useless, yeah, because
Right,
when it comes to this, because the buyers are not buying the past revenue, they're
right,
buying the future
right,
revenue. So what they're buying is really continuity, yeah.
right,
They don't pay for what happened. They don't pay
right.
for, it's not just like say, okay, well, the EBITDA last year was £2 million, therefore I just need to multiply EBITDA by 2.5 times for 3 times, and then
Yeah,
that's the valuation. Absolutely not. And in actual fact, most of the calculator, let's call it that, most of the decision will happen completely outside the financial statement.
right,
Um,
right.
so what do they pay for, really?
Yeah, yeah, yeah.
They,
That's a big. Actually, sorry.
no, I was gonna say they pay for what will continue after you leave.
Yeah,
Uh,
right.
and that's where most value disappears. I was just gonna say that, but go ahead,
Yeah.
Francisco. Yeah.
No, well, actually, I was thinking that actually this is a very interesting perspective that perhaps many people are trying to exit. They don't understand actually what actually the buyer side is really looking into, and I think it's quite revealing because then you start to understand what is the other part doing in terms of looking into your business from the different perspective or the perspective as what will happen next. And I think actually now is a good point to ask the audience what they are thinking in this point. So I'm going to ask a few questions if you don't mind to answer them or at least to think about them. So let's assume somebody buys your business tomorrow. What are they actually buying, right? So these are kind of you do a self-assessment if you may. They are buying you as a founder. They are buying a full system implemented and operational. They are buying your customer list, or they are buying your IP, your intellectual property, your team, your cash flow. So these are questions that you can start to ask today, exactly what are the other side looking in and what you can answer or how you need to start to prepare for that. So if you think about that for a second, because you answer actually is probably your valuation now. So you can start to get a pulse on your business to understand where you are standing. So let me ask you the questions again. So what they are buying, when you're buying your business, you're buying it, you as a founder, your systems, operations, or standard procedures, your customer list, your IP, your teams, your cash flow. So let's say if buyers are buying continuity, what are they afraid of after these questions? What they will be afraid of?
Okay, no, very interesting question because I always say that really you don't have to so it's not about selling customer you have, it's about a
Yeah,
system that produces customer. so
right,
so
right.
that's what a buyer would pay you for, and they
Yeah,
would pay for your absence as well, of course. Your absence is something that they will pay for because they will say, okay, well,
right.
this business is actually worth money. So
Yeah,
asking me what they're afraid of. um Very good question, and just some thinking, but they're afraid of losing control of the outcome.
right,
Okay. They're afraid that revenue disappears after the founder leaves. Okay. So they think, okay, well, especially if the quality of revenue is not great. It's,
right.
okay, what kind of revenue am I going to be left after the founder leaves?
Yeah,
Um, they're also afraid that key staff walk away. So if key staff walk away, then what is transferable here? Yeah, that's
right,
that's a big question. Let's always think about transferable value.
right.
They're afraid that processes live in someone's head. Okay.
Yeah,
they're not documented. Again, this is where I was speaking a couple of weeks ago to a business. I say, how can I scale my business? Well, if nothing is documented, AI has got nothing to scale. And the
Yeah,
same goes for the
exactly.
for your for your business as well. If you not got no documentation, there's nothing for the buyer to buy really.
Right, right.
Um, they're also afraid that intellectual property is not properly monetized, you know. So a few weeks ago, we spoke about the 5 steps of IP,
Yeah,
okay? And let's not forget that IP is not just about ownership, it's also about control, okay? You
right,
could even own intellectual property without controlling it, and your IP, your intellectual property is still worthless, you know. Believe it or not, many people think, oh, I own it. I'm clear. I don't have any problem. I can sell it now. Not really. Ownership must be linked to really revenue that will actually make your business profitable. Uh,
right,
there's lots of confusion between legal intellectual property and commercial intellectual property,
right. Yes,
between static intellectual property and dynamic intellectual property. People think, oh, what's a dynamic intellectual property? Well, it's in intangible economies, you need to understand this 100% because if you don't, the buyer will walk away. Now,
yeah,
they're also afraid that the numbers look good, but will not hold. They will not
right.
continue. Okay? Because don't forget, valuation is not just about performance.
Yeah,
What drives performance is not just about performance in itself.
right, right.
Um, valuation is also about risk.
Yeah,
Because we always say this, when risk goes down, valuation goes up. When risk goes up, valuation goes down because risk
right,
is really determines the multiple. Um,
right,
but more than just the risk, more specifically, is the risk that the buyer perceives. Yeah. So if the
right,
buyer perceives a risk, even if it's not there, you need to assume that you're gonna get discounted heavily as well.
right. So what and because oh right, interesting. So instead of asking how do I grow the business, what you're saying the founders should ask it's something different. What is that question they should be asking?
Yeah, it just counterintuitive because it's almost
Right,
like, you know, it's like uh what you need to remove, yeah? So
right,
what they should ask is what fear am I removing? Yeah.
right, right,
Because it's all about confidence. Confidence and trust, they are your currency.
right,
So confidence and trust, they are what you sell. And
right,
people will pay you against that confidence and trust. So every fear you remove increases trust.
yeah,
And
right,
trust is what drives valuation. Trust not just drive not only drives valuation. Trust is what you sell to customer. Trust is what you
right,
sell to banks. So
yeah,
trust is your currency.
right. That's very interesting because actually we say, oh, you're putting more work on me, but actually, as a founder or as an owner or as a board, but I is as you mentioned, is counterintuitive because at the end, it's not putting more work in somebody or in a company. It's actually make it easier to be acceptable to a transaction, but also to be this acceptability have to have a certain things in place to make it very attractive. So you mentioned always actually this financial architecture. You mentioned about creating wealth. You mentioned about this thing that you mentioned always. Actually, I escaped now, but actually, I'm going to come back to that one. Where predictability. That's what I mentioned. The predictability of the company. So it's not putting more work into them and trying to figure it out what's next. Because I think that here is the point that the high valuation code provides to people, and this is where the frameworks come in. So you don't have to reinvent the wheel. You have to apply this in the right sequence, in the right timing, to make it very attractive to so where the buyers come to you rather than you start to chase capital and buyers. So where is that framework coming?
Yeah, I have to say, this is where back in 2017, when I wrote the
Right,
program for the University of Plymouth,
right,
I created the high valuation triangle for that reason. Now, the high valuation triangle solves those fears structurally. It
right.
provides immediate confidence and trust, you know.
Yeah,
Why does the high valuation triangle resolve this, and how does it resolve it, you know?
right,
Well, first of all, the first side of the evaluation triangle, intellectual property monetization removes uncertainty around differentiation. Okay.
right, right,
So intellectual property answer the question, what do you own? Okay. So
right,
big question. So the first side of the evaluation triangle. And obviously not only what do you own, how do you make money out of what you own? Okay.
right, right,
So number two, succession planning removes dependency on the founder. Now, the second big question from the investor is, and it's a fundamental question, how does it transfer value?
right.
That's where succession planning comes in. There's no dependency on the founder, and many people will struggle to believe this, but succession planning is the number one big differentiator when you come to an exit. Is the
Right,
is the one item of the high valuation triangle that will increase your valuation the most. Okay.
right, right,
Number three, side number three of the high valuation triangle, scalability removes the ceiling on growth.
right,
The third obvious questions from an investor is how does it scale? So three big questions really that you need to answer.
right,
The first one is what do you own? Okay.
right,
And then obviously that's where the intellectual property comes in. Second question is, does it transfer value? And the answer
right.
is the succession planning. The
Yeah,
third question is, does it scale? How does it scale? That's where you get a global positioning, because
right,
global positioning is what gives you leverage. And by the way, most of the time, the question number three is mostly answered by question number one.
right.
If you are clear about what you own and now you make money from it, question number three will come much easier to answer, which is why
Right,
we always say you need to really apply all the three sides of the high valuation triangle, because once you
right.
do that, you are in a strong, very, very strong position. So
Yeah,
if one of these is weak, the value will leak.
right.
So inevitably.
Yeah.
But if all the three are strong, the value not just increase, the value will compound, because
All right.
you will now have a machine. You will now have something that with lots of trust, lots of confidence, you're able to say is go value transferability, which is said, you know, the key is succession planning, but obviously you need all the other side as well.
Yeah. Yeah, fantastic. Because actually, this does look back to the book as we and you already established the high valuation triangle right on at the very beginning on page 12. And now that we mentioned about structure, we mentioned about not reinventing the wheel, and I think the book is a instruction manual how to operate the high valuation triangle. And guess what? If you go at the end of each chapter, also you have the self-assessment section that I will highly recommend that you do it every quarter. So you go through the book, you go one pass, and you do your assessment, and then go back again to this assessment, like 3 months down the line, and see where you're going against the principles. So you don't have to reinvent the wheel. You have the framework, you have the assessment, you have the checks, everything in the book. And I think it's a good time, Matteo, if you don't mind, to show the trial of the book so people can watch it and understand what is the book about in length.
Yes, 90 second. I mean, I'll let you go for it. You know, it's you will definitely enjoy this trailer.
Right, fantastic. Let's go for it. Fantastic. So after the conversation here that we watched the trailer, is a fantastic way to see how all the content of the book. But I think our next question now is, instead of asking, is a new question: who will buy my business?
Okay. No, thank you for asking this question, because you know, it's sometimes it's millions, sometimes $1 billion question.
Yeah.
I've been in mergers and acquisition as well,
Right,
but
right.
just, you know, I like to decline so many deals. And last week I was just, you know, involved with a particular business as well.
Yeah,
And well, you asked you asked really what would make this business is irresistible. The reason why I'm
right,
saying that is the goal of the evaluation triangle is to make business not chasing customer, not chasing investor, not chasing banks, really.
right,
The goal of the high valuation triangle is to make them chase you. Okay.
right,
So that's
right.
why I say I use the word irresistible, because with the high valuation triangle, you can be sure that they will chase you.
Yeah, no, that's fantastic, because actually it's we are talking about many counterintuitive ideas today, like chasing you instead of you chasing, blueprints, understanding the buyer side rather than what you have to deliver, how you de-risk the buyer side, and proving all that, provided evidence. So, and here's and this is where probably the idea comes in. The exit is designed backwards, right? So continue this line of thought. So what does that actually means? Like designing the exit backwards.
Yeah, it's a bit like, you know, supply demand in the market.
Right,
If you want demand as a supplier, you need to study demand, yeah. So
right, right,
and when you study demand, you want to manufacture a product that the customer will buy. So
right,
it means you start at the end.
right,
Now, you start with the question, what valuation do you want?
right,
Okay. What type of buyer would pay it? I mean, there's a section at the end of the book that is quite important, you know, that will
right,
tell you that is one of the bonus chapter. You will love it, you know. What would they expect to see? Okay.
right.
Because if you can start to really answer this question in advance,
Yeah,
they are worth millions. You will see why in the book, really. You'll be able
right,
to see, well, this is the table of customer. So how do I behave if I got this type of buyer? How do I behave if I got this type of buyer? So it's really
right,
millions. And then you reverse engineer everything. Uh,
right, right.
your system, your revenue, your intellectual property, your leadership, your
Yeah,
governance. Um, you do not hope you don't just hope it fits, you know. You
yeah,
don't just build and then hope, okay, it's gonna fit, you know. You
right.
design it to fit, you know. Again, the word designing is not used frequently enough in our finance profession, because we all think that we just need to report the past. No,
Right.
really. We need to design the future. If you design the future with this approach,
Yeah.
let's say reverse engineering, let's call it like that,
Right. Right.
then you anticipate in the future. Many people think, okay, well, I need to wait for that moment. You don't, because valuation is not something that you wait for it and then one moment it will magically appear. You design,
Yeah.
you engineer it. In fact, what we do in this series, me and Francisco, we are valuation architects.
Yeah. Yeah, no, I really appreciate that, because and this, I think that the magic here, because people say, oh, we reverse engineer is like a daunting task. It's like, oh, who, it's very difficult, it's very obscure how you do that, etc., etc. But guess what? You have the blueprint here. So this is the design of the architecture, as Matteo said. In the book is everything there. So you can have, at least if you want to start to put your head around how to do it, there you have a blueprint. So you don't have to reinvent the wheel or go into many things to understand how it works. And also we are preparing specific courses, right, Matteo? The sprint, which is in 49 days, 12 outcomes, and then we do a cohort where we work one-to-one with people. And eventually, if you want a highly personalized, tailored process with your company, we work one-to-one with you. So what about founders who say, I'm not thinking about exit yet, because they say, yeah, probably in time.
Yeah, this happens all the time, actually.
Yeah.
But that's exactly when they should start.
Right.
As I said, valuation is not something that happens as a miracle. The moment
Right.
you need to make a calculation, the best exits are not prepared at the end. They
Right.
are built over time. And even if you never sell, you still win. You
Yeah.
still win immediately. Why? Because you become more bankable. Okay.
Right.
We've been speaking about bankability. Why
Yeah.
capital say no? That was one of the first few episodes we did,
Yeah.
So you're gonna become more bankable, so you're winning.
Yeah.
You're gonna become more investable. How can you not win if you become more investable? Yeah.
Right.
So it's another win. You're gonna become less dependent, and that's another win. It's about really making the founder absolutely more free, to
Yeah.
run the business. And again, high evaluation, less dependency as well, more optionality. I mean, to put a price on optionality is not fair. Optionality is priceless, absolutely
Right.
priceless.
Yeah.
Now, most scalable, what does it mean, most scalable? Even if you're not going to sell, most scalable means you're going to conquer more markets. You're going to
Right.
conquer more geography. If you have, for example, properly done the intellectual property monetization, you know very well that when you go overseas, when you go to a global markets, you now have the intellectual property to be distributed, to be licensed, to be franchised. Yeah.
Right.
So exit thinking is not a tool about living.
Right.
It's about building properly and
Right.
win, as we said, as we
Yeah.
said.
Yeah,
Okay.
fantastic. And I think actually this is I'm going back to the book again, because actually this where if you want to take your time to go through all these concepts again and again, and this is stated early in the book too, on chapter 1, page 35, if they say founder fantasy diagnostic, right? Because actually sometimes the founder have expectations, or they don't want to prepare. Here we are on the founder fantasy diagnostics. And there are three things that are mentioned: that the traction does not guarantee defensibility. So actually that's something that you mentioned at the beginning. So if the founder have a track record, or we audit the past, it doesn't mean that actually the future is guaranteed. And the third point, or the second point, is that brand presence alone is not a mode, right? So branding, you have to be careful there. And finally, our favorite, vision must translate to IP, how to monetize and protect your IP. So I think that this is stated already early in the book, that actually it is a design. It's not something that actually you go and say, well, when I'm exiting, I'm going to think about it, because you have to start to build all these things to be transferable. So probably merits a good question here to the people listening. Let me ask you this. If a buyer looked at your business today, right? So imagine that somebody comes and say, we are interested to acquire you, or you are interested to sell, and you have a buyer in front of you. Would they see an asset or a dependency, right? Because that's the real question. Not whether you are busy, not whether you are growing, whether the business stands without you. And this is something that Matteo illustrates in different ways and forms and shapes already. So the question again, if you want to make a note, is would they see an asset from the point of view of a buyer, or a dependency? Right.
Mhm.
So, Matteo.
Yeah, I was saying before the difference between optionality and dependency.
Yeah.
Optionality gives you Money gives you energy, gives you time. Dependency does the opposite. Yeah.
Right, right,
What I would say is most founders do not realize this early enough. What do they do? They build revenue, but not structure.
right,
They grow, but they don't document.
right.
They succeed, but they remain central to everything. Yeah.
Yeah,
So when a buyer arrives, they don't see an asset, they see a dependency.
right.
And dependency get discounted, unfortunately. That's the
Yeah,
problem. You need to build optionality. So
right.
you build revenue, yeah, but you need to really build structure. You need to
Yeah,
document. You need to document your processes, especially in an AI-driven economy. You're going to get punished if you don't do that,
right.
because your competitor will do it, and AI has got nothing to scale. So
Yeah,
obviously, you need to build optionality with a succession planning.
right, right. And a quick question. So, if we go practical now, what would be one thing that founders can act right now based on this information?
I would say, obviously, if I had to choose one, I'd say revenue quality, because
Right.
not all revenue is equal. Buyers look at whether revenue is predictable,
Yeah.
whether it's recurring, whether it's transferable, whether it depends on the founder. Just giving a numerical example, you can have £5 million in revenue
Right.
and still be worth less than a business with £3 million,
Right. Right.
because the second one is predictable, and predictability really drives value.
Right. So I guess this example, the numerical example particularly, is very relevant because that is where the founders start to get or fear of due diligence, because they say, "Oh, I'm thinking about to get this out of the in terms of valuation, but due diligence probably is going to knock that down." So what is it they should and shouldn't do in these cases?
Due diligence. Well, they should not
Yeah.
fear the diligence, of course. They
Right.
should use it early and ask, um, what would a buyer challenge? I mean, these are all questions
Right.
in the book. You will find this. You will be prepared. What would
Yeah.
a buyer challenge? What would reduce confidence? What would trigger a discount? Again, you want to
Right.
think about, you want to anticipate what you don't want.
Yeah.
You don't just say what you want. You need to anticipate what you don't want. So
Yeah.
then fix it before anyone asks.
Right.
Due diligence is not a threat, it's a blueprint. And this is why, by the way, for example, we have engaged in something called valuation physics, where
Right.
ahead of a capital event, for 6 months, we work very deeply onto a business, one in Spain, one in Switzerland, where we remove uncertainty, we remove what you need to remove before you actually go to a buyer or you go to a capital event.
Yeah. Yeah. No, I really like it because actually the most prepared businesses and the ones that can defend better their valuation are the ones that they do their own due diligence before even going to market. So as you said, they design the exit or the valuation even before the events start to be visible outside the doors of the company. So how you consider that? So the exit is not a moment really.
Yeah, the magic word here is designing. Okay,
Right,
you design the exit, you design
right,
the evaluation triangle.
yeah,
Every decision you make either increases transferability or increases dependency effectively.
yeah,
So it's one or the other one, yeah. So obviously, you know what you want to increase. You want to increase
right,
transferability.
right,
The market pay is very different for each. And I'd like to take the opportunity actually to ask everyone. We now have a scorecard that you can fill it immediately
right,
against your 12 outcomes. So you can actually measure yourself against what will make you transferable, give you
right,
more transferability, or increase dependency.
Right.
What we will do once you have filled up this scorecard, we'll give you diagnostic. So
Right.
the diagnostic is based on the answer they will get from you, and we will reply to you directly, individually. So you'll be able immediately to see your position
Right.
against
Right.
those 12 outcomes that you need to achieve in order to be investor ready, in order to be ready for an exit. But let's not forget, it's not just about being ready for an event. It's
Yeah.
about really having a business that attracts customer, banks, and investor.
Yeah, because yeah, so I think it's a very, very valuable point there, because actually perhaps the intent is not to exit right away, but just to understand how to improve and how ready you are to grow, to scale, and how predictable is your company. And this is probably some of the interest. It's not really going to the market with the company. Excellent. I think that we're reaching out to the point where we can wrap up this episode. And next week, I think is quite exciting, because we are going to see how to get from 3x or 4x a company, and why other companies get 12x, right? So it's impossible. It's not possible. It is possible. I think actually applying all these principles and blueprints and frameworks are the key. So any last thought or takeaway today, Matteo, to close the chapter today?
Yeah, the takeaway is really don't wait. You need to anticipate and design.
Right.
And you design your exit. And by designing your exit, you're doing so many other things as well. You're becoming a business that can scale with AI, for example, a
Right.
business that can attract customer more easily. I
Right.
would
Right.
like to invite you, type scorecard if you want to receive a link
Right.
scorecard, so that you can apply all this into your own real environment, and we'll
Right.
send you a diagnostic. We'll send a
Yeah.
diagnostic, and we can also book a 15 minutes review of the diagnostic as well with you.
Right. Yeah. And it's private and confidential, by the way. It's not shared with anybody. It's not an open AI thing that actually ChatGPT's model is a closed system, highly confidential and private. So you can do it with confidence. Right. Excellent. So I think that this is for this week. Thank you very much, Matteo. And we'll catch up next week.
Thank you. Thank you. Bye.
Thank you.